Well, thanks for joining everyone today. Today we have Dr. Chris Wolf from Cornell University with us. He's their dairy economics specialist. And so with that, he's going to talk about dairy marketing and what the future might hold for us. So Chris, whenever you're ready.
All right, thanks, Haley. So happy to be with you guys here today. I'm going to talk about the dairy market and policy situation, although heavy on market and light on policy, unless people have specific questions. So basically, at the current time, we're looking at a 2022 that looks pretty darn good from a milk price point of view, at least for the base prices. This graph right here was the close of futures, class 4 being the green line, class 3 being the red line. Now, and for the last couple of years, we definitely had seen class 3 being the leader as far as being higher than class 4. And that's not where we're at this year, which has some interesting implications for production and for producer prices, depending on where you're sitting at in the country. We'll talk a little bit about that. Still, if you look at the vertical axis here, you're looking at class 4 prices that are averaging about $23 or a little bit better per hundredweight as of the current time. And you're looking at class 3, so cheese milk prices that are more like $21.50. And that would be the highest prices that we've seen for a year, definitely since 2014, which was, of course, an outstanding year. Since then, we've had a lot of turmoil in the dairy markets. Of course, you know, it's not all gravy. If we're looking at 22, 23, possibly $24 class 3, class 4 milk prices, all milk price should be somewhere for the US in that 23 neighborhood, maybe a little bit higher. Your price, of course, depending on where you're shipping your milk, what your hauling costs are, and a few other things like that. But the feed prices, and we'll get into that, are obviously significantly higher than we have been seeing for the last couple of years also. Still, this is the income over feed cost margin. That's the part of the dairy margin coverage program. And I'll circle back to this at the end. So this is the US all milk price minus the average kind of US feed cost, which of course is nobody's particular feed cost, which is a weighted average of the NASS corn price, the NASS Supreme alfalfa hay price, and the AMS Central Illinois rail soybean meal price. And so kind of the dashed line here is where the futures market is currently forecasting. And that's using the milk futures as well as the corn and soybean futures. The solid line is where that margin has been for the last 2-3 years. And right now, that margin is, would be the strongest year that we've seen definitely on this graph. And the yellow portion here of this graph is the kind of middle 1/3 of the historic distribution of that margin. And so at the current time, even with corn prices being, $5.50, soybean meal prices being, 13, whatever they are at the current time, I haven't looked today, 12.5, 13. We still are looking at margins for this particular measure of income over feed costs being above $10 for the entire year. But there's a lot of uncertainty there. So let me kind of start by telling you where I'm going to end up, and then we'll go through and we'll end up here at the end. 2022 looks to be the highest U.S. farm milk price year since 2014, but there's a whole lot of sources of uncertainty. On the demand side, we're watching inflation and the potential income and purchasing impacts that has. We're concerned about COVID. I'm not going to spend much time on that. We're all tired of talking about it. And also, international trade is really a big source of uncertainty. On the supply side, we're looking at feed costs. We're looking at the labor situation, which varies a lot depending on where you're at. But right now, labor markets seem to be fairly tight. And it's not just labor on the farm, right? It's labor to run the plants, to add another shift. If the cheese plant or the butter plant or the yogurt plant wants to do that, it's also labor for trucking. And right now we're in a situation where that's a big struggle as part of the supply chain. And then finally, And I'll talk about this very briefly. It's the co-op based programs, especially where I'm sitting in the northeast part of the United States. The co-op based programs are really putting the brakes on what would be an expanding milk production at the current time, but has not really because of them. So let's talk about these sources of uncertainty. This is the Consumer Price Index, which of course is the measure of inflation. And the blue line is all items, and the red line is all items taking out food and energy. And when the Federal Reserve is looking at inflation and they're kind of making their decisions about whether they need to be changing the monetary and fiscal policy because they're worried about inflation, and they're also worried about employment and GDP, but specifically thinking about inflation, they're looking at the red line. They monitor the prices without food and energy because food and energy prices tend to be much more volatile, and they don't want to make decisions in reaction to what might be a very short-term change in food and energy prices. Still, this graph goes back to 2017 to the current time, and you can see that we've obviously had a lot more inflation in the last year, and in particular in the last 6 months of 2021 than we had been having historically. The Federal Reserve wants to see that red line in the 2 to 2.5% area. So you want some inflation, you don't want the risk of deflation, but you want it controlled and you want it fairly low. We ended the year, at the 5 to 6% range, 7 to 8 if you include food and energy. And that's why the Federal Reserve has been looking at rate hikes to kind of put the brakes on a bit. Historically, we're still at fairly low levels of inflation. It's just that for the last 20 or so years, we hadn't really been in this area much. Right? This graph goes all the way back to 1960, and you can see how the extreme inflation was in the early 1980s. Of course, then we had a pretty serious recession caused by the Federal Reserve cranking the interest rates up to the 15 to 18% range. If we're looking at what's driving this inflation, a big portion of it is transportation. So this is the Producer Price Index, which then, if you purchase transportation services, becomes part of your Consumer Price Index, right? So this is the Producer Price Index for truck transportation of freight, and you can see how the cost increased greatly in the last year, which is driven in part by fuel and energy prices, and in part by labor prices, which incorporate a whole bunch of different factors, including the fact that COVID has resulted in more people being less willing or potentially less able to work, especially if they've got somebody at home that they have to take care of and they don't have school or they don't have daycare. When we look at what's driving the prices of inflation in general, this graph right here, which is from the Council of Economic Advisors, shows the sources of the inflation. And the single biggest factor in driving inflation on here is increasing energy costs. And then food is that kind of gold line. And then you've got some other things, including purchases of new vehicles and housing and things of that nature. But definitely energy is a big part of what's going on here. And that's also, I think, why a lot of people at the current time have a fairly negative view of what's going on in the economy, even though for many people, their own personal economic situation is not bad. We're all kind of noticing the inflation and feeling the inflation, and it's something that you just can't kind of get away from. And so this is part of kind of the uncertainty on the demand side that is behind this, is at some point, these increasing costs start to bite into purchases. If we look specifically at the food, so food here was this kind of gold bar, and you can see that was a pretty significant portion towards the end of 2021. And if you look at what the change year over year was for 2021 compared to 2020, you see steak price up 21%, beef in general up 19, bacon up 19, eggs up 11, chicken up 10. Milk is down here at 4.2, which is a higher than average, certainly increase in price, but not nearly as high as some of these other things. And basically, a lot of what's going on with the food inflation in the last year is meat. The meat supply chains have been really challenged because of the COVID situation, because of the labor and the transportation and everything that's gone on around handling the pandemic. And if you just take the meat price increases out of food, that takes most of the inflation away, which I like to eat meat. And so that's, I'm noticing that. But, to the extent that we could work through some of those issues that are related to driving the meat supply and the meat price increases, that would certainly help with the inflation situation. But the net effect being that if you have all these price increases, that is effectively a decrease in income unless your income is keeping up with this inflation rate. And most people are not seeing wage increases that are 5, 6, 7%, which is what they would need to be keeping up with this inflation rate. So in effect, you're getting a real decrease in your purchasing and income. If we look at food expenditures, just kind of looking back at the pandemic briefly, if you see 2020 food away from home expenditures, which includes services, so tips and wages and things of that nature, whereas we had historically for the last few years seen the expenditures on food away from home be above expenditures on food at home. And by the way, people still eat more meals on average at home than they do away from home. It's just that the meals that they eat away from home are much more expensive because of tips and wages and so on and so forth. So you saw a big decline as people sheltered at home in the pandemic. We did see it recover in the middle to second half of 2021, where we had away from home expenditures now exceeding. But you'll notice that this graph kind of ends in October 2021, which is really before the last variant wave came through. And so it will be interesting when they update these numbers to see if they went back down again. The other thing to note is that this decline here in this orange line, this big drop off from trend, was people being laid off and not being paid that worked at restaurants and other service industries. And so that also was lost income on their part if they couldn't find some other way to make it up. But the importance of this kind of change from eating out a lot to eating at home much more in 2020 really showed up for the dairy industry, because it turns out that people eat dairy products much differently when they're eating out versus when they're eating at home. So if you look at 2020 compared to 2019, whole milk consumption was up 3.3%, 2% milk consumption was up 3.6%, 1% in skim milk were down, and total fluid milk consumption was essentially flat. And that was a pretty big change from what we've seen in the previous 10 years, when the average decline in fluid milk consumption was down 1.7% per year. And this is an aggregate, not per capita. Over this time, the population is still growing. So if we were to graph per capita milk consumption, it would decline at a bigger rate, about 2.2%. And so it jumps out that 2020 leveled off here, which was a pretty big change. We hadn't seen kind of that type of change in 15, 16 years. Cheese consumption, also people eat different cheeses when they eat out versus when they eat at home. Cheddar consumption was essentially flat. Mozzarella consumption was down. Even though people were doing lots of takeout pizza, they still would eat more if they had been going out than they were eating at home. Swiss cheese production was down. Blue cheese consumption was down. Cream cheese consumption was way up. That was part of people eating more breakfasts at home. Cream cheese consumption up 7%. In fact, cream cheese consumption was up so much that we had a cream cheese shortage in New York City this last year. Hispanic cheese consumption up. So total natural cheese consumption was basically flat. Processed cheese consumption took a hit. People, even though they were eating at home, they ate less of the processed cheese. Ice cream, if it was regular fat, was up 4%. If it was low fat, it was up about 2%. And if it was non-fat, it was down 3%. And yogurt was up 3.3%, which was not as high as yogurt consumption had been growing 10 years ago, but better than it had been in a few recent years. So the lessons then from Americans eating at home is that full fat products were the winners. Okay. People have figured out, well, maybe they already knew, they should have, that full fat products taste much better. They've noticed that eating full fat products fills you up, which is better because then you're not, continuing to eat. And the research is continually showing that full fat is not bad for you and is an important part of the diet. The other thing that we're seeing is that people eating breakfast at home had a big impact on the dairy product consumption. So more beverage milk consumption, whole and 2%, more yogurt consumption, more cream cheese consumption, and then less specialty cheeses, right? So if we look back here, the Swiss cheese, blue cheese, I didn't put the other specialty cheeses on here, but people are much more likely apparently to eat specialty cheeses when they go out to restaurants. That wouldn't be true in my household, but it was true here. And then unfortunately, we get the 2021 numbers and we see that after kind of stalling out, the decline stalling out and even growing a little bit in 2020, as far as fluid milk sales, we've gone right back onto the trend as the economy opened up and people went out. So, maybe we just need to make certain everybody stays home, they'll drink more milk. Or maybe we need to figure out more ways to get people to consume beverage milk when they're out. Would be another, part of the story there, I think. If we kind of switch over to the production side, 2021 production on the whole was below trend for the year. It's the red line here. That 4.6% increase year over year in May was in part because the milk production was down so far in May of 2020, which was really when we kind of got in hard into the pandemic and milk production was cut back real sharply with a lot of co-op based programs, really discouraging milk production on a significant percent of the United States. And so it's a little misleading to have that 4.5% because that's over a negative 0.5% change from a year earlier. But you can see even with that, there was a dramatic slowdown in milk production in the second half of the year to where we were even a little below. We were at zero or negative essentially for the last 4 months of 2021, below a year earlier. Now, 2020 was high towards the end of 2020 and above trend. So in aggregate, we end up at like we end up just a little bit below trend. Trend is 1.7. We were like 1.4 for the year for 2021. Dairy cow numbers, they peaked in May at 9.5 million roughly, and then declined fairly sharply in the second half of 2021, which was in part because of high feed costs. It was in part because of high coal prices. It was in part because of co-op based programs and a whole bunch of other factors. That May number was actually the highest number that we'd seen in more than 25 years in dairy cow numbers in the United States. So that was a pretty big number there, but we've since dropped back down to, below 9.4 million. So we've culled a lot of cows in the last 7 months of the year. And as I said, part of the story was that the price received for cull cows was higher than it had been. It's probably, hopefully, profitable at the current time for you to be milking cows. It might also be profitable to be culling some cows. And, those high beef prices have worked through to the derived demand for cull cows. And, $75, $76 a hundredweight for cull cows in July and August was pretty decent price. Still in that $69 area for the United States as a whole. Of course, it's going to vary depending on where you're sitting. U.S. milk per cow per day, so milk yield also really slowed down in the second half of the year after being really high in February, March, April, kind of above trend growth. Then we kind of came back down. And I'll talk about that in a minute. So factors in the supply response, the big ones were weather, feed prices, and co-op based programs. This is the drought monitor from July of last year and then just recently. Of course, we're growing the crops in July. We're not growing the crops in January, but if you look at this at the upper left-hand picture right here, you can see how much dark red and orange, so extreme drought and exceptional drought there was, particularly in the West. You look at the Central Valley of California, you look at the Sierra Nevadas, which is where the water is coming from for the Central Valley. You look at Oregon, you look at Washington, you look at Idaho, all important. You look at Arizona and New Mexico. These are all important areas for milk production. And, there's still a lot of forage grown in a lot of these areas, right? So you don't necessarily think about forage in the Central Valley of California, but California is still the second biggest producer of corn silage and is in the well into the top 7 or 8, I believe, for alfalfa. So that, was definitely affecting the expense of growing crops out there, and the resulting feed costs. You look at the January one and the February one. I didn't put it up here. I just kept the January one here, but the February one looks very, very similar. The snowpack has been really decent, and it's certainly possible, and hopefully it will for the guys out west. They'll have some water available, much more than they have this next year, but that doesn't help right now with feed costs, right? We're not, although we're not that far from being able to do some cropping in California because we are approaching March. But still we're working off of last year's crops, and it's a lot more expensive. This is the NASS price received for corn. So this is actual supposedly price received at the farm level, national average. So there's going to be a lot of variation depending on where you are. But you can see in 2021, we were at 6.25 there in August. A little bit of drop off down towards a harvest, but then even increased more to 5.50 to finish off the year. That's much higher corn prices than we had been seeing. You got 2019 and 2020 there, which for the most part were below $4. And in 2020 down to almost $3, below 3.25 in the middle part of the year. So this is significantly higher feed prices. And if you're in the cash market, right, if you're living in the cash market, then you're feeling this directly. If you're not, it's an opportunity cost, but maybe not affecting you as much. But certainly for the guys out west that didn't have a good crop and had to be purchasing corn, alfalfa, soybeans, they're definitely feeling these prices. And just kind of as a side note, when we're thinking about the planting for this next year, there's going to be a lot of questions about how many acres of corn are going to be planted. Usually there's somewhere between 90 and 95 million acres of corn planted in the United States. And normally prices like this, $5.50 to finish the year, we would be looking at a lot of acres coming out of some other crops and going into corn. But part of the reason that we might be concerned that we're not going to get that kind of response to bring feed prices down is this is just this is fertilizer costs, which are directly related to energy prices and also are going to be heavily influenced by any geopolitical issues that we have coming up this year, and hopefully we avoid those. But so this is nitrogen. This is UAN 28, which is urea, ammonium nitrate 28, which is obviously nitrogen. And this is just an example of what happened in 2021, where we apparently had never seen the price of this, or at least not in many, many years, be above $600 a ton. And you can see that by June, we were at above $600 a ton, and to finish the year at nearly 800, and then it's still going up as of February 4th here. So if you're looking at crops that are going to require some nitrogen, like corn, for example, then you're looking at a high cost here, and that's going to cause some people in your part of the country throughout the Corn Belt to look hard at whether they want to be planting corn or not, and what's going to happen with that resulting prices. This is just a tweet from a gentleman who follows fertilizer prices closely, and this is in reference to Russia, which we've all been seeing in the news a lot lately for some not so great reasons, and says, why are we watching Russia closely for fertilizer? Because from a world export perspective, they represent 14% of the urea, 27% of the UAN, which is what I just had up there. And they and Belarus represent 1/3 of global potash. So, to the extent that we hopefully don't, but if we do get into some set of geopolitical issues with them, that's not going to help fertilizer costs. Hopefully everybody's got it purchased and we're not looking at big shortages that way. Soybean prices, of course, tend to follow corn. They go together. We've got soybean prices not, at $12.50. The rule of thumb I was always told was soybean prices need to, if soybean prices are above 2.4 times the corn price, then acres will go towards soybeans. And if they're below 2.4 times the corn price, then acres will go to corn. And so that was kind of the rule of thumb that I was always taught. And I don't know how much it still applies, but if you look at this at 550, corn, 1251 soybeans, that actually says that's right on the borderline, but it's probably just a smidge favorable to soybeans right there. But that'll also be affected by things like fertilizer costs. Price received for alfalfa hay just went up throughout the year. We had issues with drought in the west. We had issues in the part of the country where I'm in the Northeast, where we couldn't make hay because it just, from basically the 4th of July on, it just seemed to rain constantly. I don't know what it was like in Ohio. Hopefully you guys had a good growing year there, but it was really hard to make good hay here in this part of the world. And, this is showing up with these hay prices. NASS price received for alfalfa hay well over $200 a ton. And that's not really necessarily dairy quality hay. There's a lot of variation going on behind this in the way they define it. But you can still see where that is relative to where we had finished the previous 2 years, which was more like $170 a ton. 210 is, more than 20% above, 25% above roughly where we had been. So hay prices are not cheap either. This is from the University of Illinois, Scott Irwin, Joe Jansen. This is intended total planted crop acreage. So this would be essentially acres in corn, soybeans, and wheat put together. And what they kind of show here is that in general, it's positively correlated to the previous year's corn price. So again, the more kind of higher the corn price it is going to pull along that soybean price and wheat price because they're competing for the acreage. And the projection here is adding 7 million acres and those crops this next year based on where the corn price is. But I think a lot of that is going to depend on people, on fertilizer and fuel costs and people looking real hard at what their options and opportunities are. But that's definitely going to be a factor to watch going as far as margins for the dairy this next year. This is the value of the dairy ration that NASS calculates and puts out on a monthly basis. The green part is the alfalfa portion, and then the tan part's soybean and yellow is corn. And you can see that we have much higher kind of total feed costs to finish 2021 than we did for the previous 4 or 5 years. 2012 and 2013 were higher than where we are currently now, but not since that time. And that's putting a damper on production response. If you look at where we were for December year over year milk production by state, California was actually up a little bit, but that was down from a not great number the year before. Wisconsin, Idaho, Minnesota up just a little bit. Texas up strongly at 3.5%, and that's over a very strong number from the previous year. Texas has been growing like gangbusters, adding lots of processing capacity out in the panhandle. Just the other side of the border, though, New Mexico has been dropping through the floor. Milk production down 15%. Washington production, state of Washington, down 7%. They were really hammered hard by the drought and the heat that they had last year, and it's really affecting their milk per cow and their feed costs. Pennsylvania and New York down. Part of the story with Pennsylvania and New York, a big part of that story is the co-op base programs. And then you've got Ohio down 4%, Michigan down 1.2%. So, milk production response, even at these high prices, and we finished the year with pretty decent prices, and we've had a strong outlook now here for a few months. They haven't been strong, and it's it's the feed costs, it's the labor situation, and it's the co-op base programs, depending on where you're shipping your milk. One thing that I've noticed in looking at farm business summaries for the last couple of years is the variation in kind of the prices received across the farms, which is really driven by where they're shipping their milk to, what the kind of contract and premium situation is where you're shipping your milk, and then whether you've been able to collect government payments and have an effective risk management program are really driving variation in price received. This is daily production of American cheese. Down in the second half. If we look kind of longer term now, monthly cheese production has been growing, 1.6 million pounds a month on average over the last 5 years. We've added a lot of the new capacity has been in cheese production, and that's part of the story of what's going on now with the divergence between class 3 and class 4 price. Is this the big new cheese processing facilities have got contracts and they're going to get filled, and because they're getting filled, we're producing more cheese, but we're not producing as much dry whey. So this is dry whey, and you can see for 2021, it's kind of down to flattish, especially from where we had been in 2019. And part of the deal is that the new plants are producing different co-products along with cheese. They're producing dry whey, whey protein concentrates and whey protein isolates. This is average daily production of butter, which spiked up during the pandemic and then has been much weaker since then. So part of the milk production that's been pulled into cheese has been taken away from butter. So even though we've seen really high butter prices, we haven't seen a response in butter production like we might expect, because the class 4, the butter production has been, filled after we've gotten the cheese production filled. Monthly butter production, longer term, up a little bit year over year. You can see the seasonality in that picture right there. Non-fat dry milk production is also down following lower butter production. And then this one's out of place here. But if we look, you can see that the dry whey production, which is the yellow line here, dry whey production has been trending downward for the last 5 years. Again, that's because there's money to be made in making different whey protein concentrates, whey protein isolates, and other co-products when you're making cheese, if you can, as opposed to you're making more traditional dry whey. So to finish the year for 2021, we'll be getting a new stocks report soon. Monthly ending stocks of American cheese are strong, and that's part of what's kind of been, if you've been watching the cheese market in the last 2 months, you've seen there's been a lot of up and down in response to when we get a new report out about cheese production and cheese stocks. This is American cheese stocks of about 850 million pounds. If you do go total cheese stocks, it's a little over, it's 1.4 billion pounds of cheese stocks, which is high-ish. It's not terrible, actually, if you look at stocks to use ratio compared to what we have been seeing recently. So, but this is part of the reason why class 3 has been lagging a bit behind class 4. And this is the spot cheddar cheese prices, the barrels in green and the blocks in red. And they had been pretty divergent for a large period of time, but recently have kind of come back into line as the block prices have kind of come down to where the barrel prices are. Ending stocks of dry whey are low. Again, we're not producing as much dry whey relative as we had been, and whey prices are strong. Okay, so you got to pay attention to the vertical axis on here because it starts at 68 cents. But we saw whey prices that got up to over 85 cents a pound. Since then, they've kind of fallen back in the last couple of weeks, but we're still at 80 cents a pound or so, which is strong historically for whey prices. Stocks of butter are much lower to finish 2021 than they had been to finish 2020, and that's definitely contributing to spot butter prices where, to start the year, we had been below $2 a pound. To finish the year, we're more like $2.70. And at one point, we flirted with, getting near $3 a pound. So strong butter prices. But this also reflects the fact that not only is butter consumption up, but different cream consumptions are up. And so there's really competition for where the butter fat's going. Ending stocks of non-fat dry milk are actually down. And non-fat dry milk prices are pretty high compared to where they had been. Again, so if you put this graph right here, non-fat dry milk, together with the butter prices, you can see why we've got a really strong class 4 prices, because those two are going to class 4. And then that's also why we've had a divergence in between the class 3 and class 4 contracts. So if you look here, they were much closer together a couple months ago than they are right now, and they've since diverged as kind of cheese production has remained strong, but butter production has not remained as strong. And the same thing, but to a lesser extent, if we look out 6-8 months from now, October is traditionally the highest milk price of the year at the farm level. So a lot of times I think it's useful to look at March, which is traditionally the lowest milk price, and October, which is traditionally the highest milk price. But the markets are definitely predicting that this relationship continues, which also means, by the way, that, depending on where you're at, you really shouldn't, if this relationship continues, we shouldn't be seeing negative PPDs, and certainly not anything like what we were seeing in 2020. Dairy trade, we finished 2021 at kind of the strongest level that we had been. As far as we set records the previous 2 years for value of dairy trade, 2020 and 2021. If we look at it, this is just released for the U.S. Dairy Export Council. Total export value in 2021, 7.7, almost $8 billion in dairy exports, as 6.6 billion in 2020 and just about 6 billion in 2019. So that's a pretty decent change there, 18% change in export value, a 10% change in milk solids exported, which means that prices were much higher in 2021 than they were in 2020. And, real strong increase in skim milk powder, non-fat dry milk, dry whey, cheese up 14%, which is good. As we continue to add more cheese processing capacity, we're going to have to export more cheese over time, or we're going to end up with a lot more cheese in this country. The butter number jumps out in a percentage change at 121% over the year before, but that's really largely reflective of how little butter we've been exporting, right? It's much easier to have a big percentage change when you're not exporting much. And if we look at where the exports have been going in terms of milk solids, SEA is Southeast Asia, which is 9 countries in Southeast Asia, including Korea and including Indonesia, Vietnam. I can never keep all of them straight. But so that's not a single country. The biggest single country that we exported to was Mexico, which dairy exports had been down dramatically in 2020, which kind of shows up. It's a little bit hard to see in the graph here, but the dairy imports, so exports from us into Mexico, had been down dramatically in 2020. And that's because Mexico was hit much harder than we were, believe it or not, by COVID. And their purchasing power was down. The peso was down. They had lots of health problems. They had lots of logistical problems, and they purchased a lot less product from us. It rebounded nicely in 2021, but we still aren't sending as much dairy products to Mexico as we were in 2018. The other story is China, which is the third country, or the third one on here, the second single country. And China tends to either be in or they tend to be out. And so you can see there's a lot more volatility in the amount that China is importing from us, but it was up very strongly to finish 2021. 2019 was down dramatically, and a big part of that story was the little trade war that we had in 2018 into 2019, which really affected how much they imported from us. So, which is also why we're watching this geopolitical aspects. If we look at how much of our production that we exported to different products, and then is the middle column here, and then the third column is the share that U.S. products exports are of the world trade in that product. So we only export about 6% of the cheese that we produce, but that's 16% of the cheese that gets traded in the world. We only export about 2% of the butter, but we export over 70% of the non-fat dry milk, skim milk powder that we produce, and that's more than a third of all of that product that gets traded in the world. We export about half of our whey products that we produce, and that's also about a third. We export about 3/4 of the lactose that we produce. So, really not much with the kind of cheese and butter, but much more with the powders and the other products. So we're exporting, in effect, a lot of the milk proteins, consuming most of the fat domestically, also consuming the majority of the skim milk products, the dairy proteins domestically, but exporting much more of those than we export uh, of the fat products and the whole milk products. And the results of this kind of increased amount of exports that we've had in the last 15 years, but in particular in the last 5 years, is that we're much more correlated with world prices for those products that we export. So US product prices for dry whey and skim milk powder, over 90% correlated with world prices. Butter and cheese prices also correlated with world prices, but to a lesser extent. In particular, butter, because we're consuming virtually all of it domestically. And so the effects of trade is that with domestic butterfat consumption increasing, it helps us balance the solids, not fat, the protein, the milk protein production, right? Without it, we'd have to find a home here or do something else with our protein production. And so that's good news. It helps us balance our markets. This, in effect, is what Canada has a problem with, because if they set their milk production for their butterfat needs, then they way overproduce proteins, and they can't get rid of it without dumping it on world markets because they've set the domestic prices way above world prices. And whereas we have our domestic prices for those products at world prices and we're competitive. The downside of the trade is that it leaves the dairy industry susceptible to these geopolitical conflicts. Okay, and I'll kind of circle back to that. If we look at where we're at right now for farm milk prices, this is kind of hard to see maybe. This is from the European Dairy Monitor. I find it useful to kind of monitor. This is meant to be farm milk prices. This is for 4.2% butterfat milk, so which is actually not that different from what we're producing on average now, because we're above 4% butterfat in this country. But you got to keep that in mind. And this is also in euros per 100 kilograms of milk, because we're the only place that does it in per hundredweight. So the point of it is that we're actually fairly well aligned between New Zealand, the European Union, and the United States at farm milk prices, whereas in 2020, we were well above kind of those prices. At this point, we're actually just a little bit below. So we're definitely competitive, very competitive. If you look at the European Union, for 2021 over 2020, they're actually down a little bit in milk production. If you look at Australia and New Zealand, both of them are down. Australia down 2%, New Zealand down over 3% year over year for milk production. And the story in the European Union, Australia, and New Zealand is a combination of weather effects, of labor costs, and of regulations, particularly environmental regulations. And that's really showing up in New Zealand and in some of the European countries, which has really put a damper on their milk production growth and is forecasted to continue to do so, which is part of the reason we're seeing this kind of strength in milk prices. Is we're not anticipating the normal kind of robust response to these prices that we normally would see at these milk prices. And then there's also what's going on at home with the feed prices, with the labor costs, and with the co-op base programs, all of which leads us to expect kind of a muted supply response. And then, the biggest source of uncertainty right now is the geopolitical potential for geopolitical conflicts and the effects that will have on directly trade for dairy products and indirectly on energy prices, on fertilizer prices, and therefore on feed prices and things of that nature, right? In February 2014, Russia invaded Ukraine and the Crimea Peninsula. And that resulted in kind of big impacts and big shifts in how especially dairy products were traded. Russia is a deficit country when it comes to dairy products. They need to import about a third of the dairy that they consume, because that's kind of how far behind they are. We don't send any dairy products to Russia. The European Union does and New Zealand does. And so that didn't affect us directly, but it affected us indirectly when they put in the blockade. And it will affect us indirectly again on dairy products if we have to ratchet up that kind of set of embargoes on them, as well as directly when it comes to our fertilizer and energy prices. The China trade war that started in July of 2018 really showed up and really hammered the dairy exports to the United States, imports into China in 2019. And so those are kind of the two big sources of risk right now. If, the Olympics ends, today or tomorrow? Soon. We're essentially at the end of the Beijing Olympics. There are certain people that monitor this, not me, I'm no expert in this area, that think that if China is going to kind of crack down on Taiwan, that it will happen when, you know, the Olympics are over and we're essentially over. And so to the extent that that happens, there's probably going to be some set of responses from the United States and its allies that will be unhappy with the crackdown on Taiwan. And so that will also potentially have an effect. And so that's kind of what we're looking at for uncertainty. I already talked about the futures and the forecast. So let me kind of finish up with a couple things here. One is the dairy margin coverage program. Sign up has been extended to March 25th. So you have a little over a month yet to sign up for it for 2022. And you may want to. And you may, there's a couple different reasons you may want to. And I'll talk about why you may not want to also. First of all, the dairy margin coverage program was recently changed to use supreme alfalfa cost for dairy quality hay. That actually lowers the income over feed cost margin that's calculated by about 20 cents a hundredweight, everything else equal, given how much more supreme alfalfa costs as opposed to just regular alfalfa on the NASS prices. And so that makes it more likely that it would trigger. And you can collect payments retroactively using the supreme alfalfa price for 2021 if you go and sign up at FSA. The other thing is that this is the first time since the program began, and in its initial iteration, it was the margin protection program in 2020. But this is the first time since it began that you've been able to update base. So to the extent that you're a dairy producer who's been participating in the dairy margin coverage program, who has an established base, and remember, the first base was the highest amount you produced in 2011, 12, or 13, and it's been established since 2014. If you grew during that point in time, in particular, if you were well below the kind of 5 million pound threshold for tier 1, which is what you want to protect in this program, if you were, let's just say for the sake of argument, 2 million pounds of production when you've established that base, and now you've grown in your 3-4 million pounds, whatever it is, then this is your chance to update that base. And it will be apply for the next, for 2022 and 2023. And you'll receive retroactive payments actually even for 2021 if you update that base. So that right there makes it kind of worth considering, especially if you're in the area where you've grown a lot in the last 6 or 7 years. There's a new tool that Mark Stevenson at the University of Wisconsin has completely rewritten for the dairy margin coverage program. And it's at the link right there, dmc.dairymarkets.org, and take a look at it. It can help you kind of make some decisions about whether you might want to sign up or not. But I will say this, at the current time, given that margin, which is right here, the forecast is for no payments for 2022. So you're thinking to yourself, why are you talking about this? Why would I want to sign up for something where there's no payments? And in fact, right now at 950 a hundredweight, which is where you want to sign up at 950 a hundredweight for the first 5 million pounds, if you're going to sign up, that's the best place to be. And this applies, by the way, even if you have much more than 5 million pounds, you can still protect the first 5 million. If we're thinking about this in a risk management perspective, at 15 cents a hundredweight to protect a 950 margin, it's roughly at the current time about 30% likely to have a positive net benefit for 2022 is what the markets are currently predicting. But, I guess I want to remind you of all of the sources of uncertainty. If you start looking at options prices, class 3, class 4 options, go out there 6-8 months and look at some options. And you're going to see that they're pretty expensive, which also means that dairy RP for that time is going to be relatively more expensive too. And dairy RP has the subsidy, which helps. But the reason that they're expensive is those options are, the market is thinking that there's actually a not unreasonable likelihood that there will be a decline because of feed costs or changes in feed. Maybe we'll plant a lot more corn. Maybe the prices go down. Maybe they go up because of the geopolitical and potential for trade conflicts and all these other things, potential for us to have weather events in this country, all of these things that could happen. And if we look at it, this is the dairy margin coverage program net benefits. So indemnity payments minus premiums each year that it has existed. If we had 950 coverage, and the 15-cent premium that we currently have. Basically, there's been a positive net benefit almost 2/3 of the months, averaging about $1 a hundredweight. Now, that's skewed in part because the pay prices were so big in 2018 and 2021, which, by the way, is why you should go sign up and you can get it retroactively in 2021. But still, if we think about it from a risk management point of view, I guess I would encourage you to look real hard at what the dairy margin coverage program can do for you. And then, also make some decisions about whether you want to look at adding more coverage from things like the Dairy Revenue Protection Program and things of that nature. So sorry, that was a lot. I'm happy to take questions. I see that there's some chat, and I'm sorry I wasn't monitoring that as we went, but I can certainly go back if there's something that somebody wants to talk about. Is there anything on there, Haley?
Just a few comments that I had made.
Okay.
The metric that you had mentioned with acreage of soybeans versus corn and 2.4, that multiplier, that's really good to know. And so why the butter export? Why has that jumped up?
Why
so
did it
much?
jump? Well, partly
Yeah.
it was because we essentially exported nothing the previous 2 years. And then we started kind of recall that butter prices got real low towards the end of 2020. Cheese prices kind of went way up and butter prices got way low. And part of it is that there's a lag between when these export contracts get written and when they actually get exported. Oftentimes 3 months. So part of what happened was we exported more butter to begin 2021, and that was butter that had been priced and locked in the second half of 2020 when prices were low. But also, if you kind of go back and look, and I didn't spend a lot of time on it, the numbers, we're talking like 25,000 tons of butter, whereas we're talking, billions of pounds of the powders and stuff. So even though it was up a lot in percentage terms, it wasn't much.
Really
Basically, we need the butter fat here, right? And producers are receiving that signal that says, get your components up, right? And there's lots of reasons to get your components up, including the fact that if you have a co-op base program, the base program is limiting the amount of hundredweight you can ship, not the components. There's even more incentive to make, ship as high component milk as you can.
So moving forward, if we hit some of those geopolitical issues in the future, and exports are basically shut down. We're not sending anything out. I can only imagine that processors are going to start putting in milk quotas. How do you see that potentially affecting milk price and farms?
Yeah, well, if we end up, that's a good question. I mean, the good news is that Europe milk production is down, New Zealand's down strongly, so that should give us more opportunities to kind of substitute in for where they had been going. And, it would help if we maybe had some more free trade agreements with a couple different countries, which we're kind of working on, but maybe a little slower than we should. But yeah, look, depending on the co-op situation, if, I don't know what situation is in Ohio right now, but right now in New York and Vermont, the co-ops, most of them have the base programs on, a couple of them with pretty big drop-offs when you get to the excess or over base price. And so that's really discouraging milk production. And we definitely could see some of that. But, right now it's almost a tale of kind of where you're at, right? Texas, Kansas, South Dakota, growing like gangbusters. New York, Pennsylvania, New Mexico, going the other direction. So, the good news about Ohio is you've got water and you're a good place to grow forages and stuff. And so that's a good thing, right? I mean, longer term, you got to have forages to milk cows. So, that's good, but you also got to receive a good enough price to stick around and make it work.
So kind of along the same lines with the quotas and emphasis on components and butter fat. I mean, do you see farms potentially changing from milking Holsteins to milking Jerseys, not only for the feed efficiency, but they're getting more components, kind of more bang for their buck?
The last time I looked of the semen that was sold last year from National Animal Breeders Association, I think it was last year, it was 84% Holstein and 14% Jersey, and then 2% everything else. So there's definitely certain people that are putting some brown in there, right? And I'm no expert on the breeding and stuff, but I think part of the challenge is what do you do with the offspring then? You get the brown ones, then it's a good cross the first generation. What do you do with the next
Right.
one? Right.
Right.
So, but definitely we're seeing, between the nutrition and the genetics, we're definitely seeing, I mean, if you look at the last 20 years, what's happened with both butterfat, especially butterfat, also protein to a lesser extent. I mean, last month we were 4.05% butterfat, I think, on average for the whole country. That's a lot higher than where we were 5 or 10 years ago. And it's just farmers responding to the incentives that are being given to them, doing the rational thing. One thing about U.S. farmers, kind of all different types, is they're pretty good at responding. The price is almost too good, right? Which is why the old saying is that the cure for high prices is high prices. Right now, because of the co-op based programs, because of feed costs, labor costs, and because of what's going on internationally, maybe we won't respond as quick this year, is what I'm thinking.
Okay. Well, if there are any other questions, feel free to unmute yourself or go ahead and pop them in the chat. But if not, that was a very informative presentation for sure.
Okay.
I was looking at some of the consumer price indexes a while back, and it's crazy how much the inflation has affected.
Well, and it's partly just we haven't had any in so long, right? We've all kind of got used to, we've been at or below 2% for a long time. So this is it's sticker shock.
Very much so.
Absolutely.
But after that, thank you very much for attending.